Good morning, everyone, and thank you for joining us for the Union Plaza at Federal Center Station live webinar and Q&A session with CrowdStreet. My name is Justin Ottman, Marketplace Manager with CrowdStreet, and I will be moderating today's webinar. We are pleased to have Griffin Partners, who will discuss the Union Plaza at Federal Center Station offering on the CrowdStreet Marketplace. At this time, I do need to inform all of the attendees on the webinar that the offering is fully subscribed. For those offers that have already been placed on the marketplace and that have been accepted, your offer is going to be given a chance to complete your offering on a first-to-fund basis. Today's webinar will run between 45 and 60 minutes. We will first have a presentation by the sponsor, and then we will offer prospective investors a chance to have their questions answered by the sponsor. If you have a question to ask, please type that question directly into the question box on your GoToWebinar control panel, and I will ask the question on your behalf. And with that, I'll turn it over to Edward and Andrew from Griffin Partners.
Thank you, Justin. This is Edward Griffin speaking. I'm the CEO of Griffin Partners, also the chairman of the Griffin Partners Investment Committee. Our firm was founded in 1980. We're headquartered in Houston, Texas, and we have been in the development and investment management business for commercial real estate, primarily office and industrial assets during that whole period. Our investment management program started in 1998, and since that time we've made over 30 investments and close to 40 buildings, properties within those investments, primarily focused on the value add and core plus space in office and industrial. We are currently deploying capital for our third fund, Griffin Partners Office Fund 3, and in the process of deploying that capital, we are periodically offering opportunities for co-investment alongside our fund in the assets that the fund acquires. This offering is one of those type of offerings. Griffin Partners has a track record in our investment management business, which again started in the late 90s, of achieving mid-teens internal rates of return while also distributing approximately a 7% cash yield to our investors during the investment periods. Our senior team has an exceptional number of years in the industry and also with the firm. Myself, I have been with the firm since 2002. The company was originally founded by my father, who is still active in the business. Andrew Montgomery, who you're going to hear from in a moment, is the head of our acquisition and disposition team and has been with us for 4 years. Lee Moreland, who is the head of our asset management team, has been with us for 11 years. We're very proud of the team that we've assembled and the track record that that team has achieved. With that, I'm going to turn it over to Andrew Montgomery to discuss this offering in the western suburbs of Denver, Colorado.
Great. Thanks, Edward. This is Andrew Montgomery, Executive Vice President of Griffin Partners, overseeing our acquisition and disposition effort. As Edward alluded to, this investment is currently closed. We closed the transaction in January of 2018, and we offered this up to various CrowdStreet investors earlier in the last plus or minus 7 to 10 days, and we are excited about the opportunity, and good to hear that we have a very strong interest in the asset from the investor pool. I'm going to go through just the general investment, a couple of key deal points, the location, the overall business plan, etc. And then we can open it up for questions, and I can turn it over back to Justin here in 10-15 minutes. To start off, we purchased the project in January of 2018 for $20.9 million. This is a mixed-use office and retail investment located in the West Denver submarket. It is roughly allocated in value. We think 55% of the value is roughly to the retail, and the difference being the value to the office. The asset's effectively stabilized. There are 8 retail tenants, and there are roughly 20 office tenants. Currently in-place rents are just below market, so we think there's an opportunity to market, move rents up as the investment, our investment as well as previous ownership's investment has restabilized the asset, and we think there's an opportunity to continue to maintain the retention and push rents. Talking a little bit about the key deal points, we think we spend a lot of time focusing Griffin Partners on location-based investing, for lack of a better term. This particular asset is located on a trans-oriented development where a park and ride area and the T-Rex project of Denver's MSA. It is one of 11 main train stops in Denver. This is the westernmost train stop in West Denver, and it's located adjacent to this particular locale. Also, it is adjacent to and kitty corner to St. Anthony's Hospital, which is over a 550-bed hospital in West Denver that was built in 2011, so recently delivered, as well as 3 additional medical office buildings that support that hospital that are frankly at capacity at this point. There's also some senior living that is being developed here in the last few months we have heard about since we've closed the project, which is very encouraging as the location attributes continue to improve even since we've closed the project, with new investors coming in and looking at the market and maybe in developing new product for more pedestrian traffic, which we really like from a location standpoint and the walkable amenities that this project has with all the various restaurants in the retail that we currently own. As I mentioned, the percent leased, it's roughly 94% leased today. We cater to small to mid-sized tenants, reducing our overall, tenant exposure. There's no one tenant that's greater than 10% of the project, and therefore we have a diversified rent roll that allows us to continue to push rents, and not one tenant is beholden to us for a particular rental rate. The average size tenant is roughly 2,000 square feet on the office side. There is one large tenant that is 10,000 feet, which is Regis, which is a co-working location, very similar to the WeWork concept. We also have a number of national brand retail tenants, including Jason's Deli and Subway, and various other regional and local restaurateurs. And lastly, regarding just kind of the overall project itself and where it stands along Union Boulevard, which is a major north-south thoroughfare in West Denver, it has over 550 feet of frontage along Union Boulevard, providing great visibility and access. Since 2014, the previous owner started a renovation plan and invested approximately $4 million into the project. Those capital dollars have really transformed the asset. The new retail eyebrows with new signage, new landscaping. They've resurfaced the entire parking area. They've added new elevator cabs and new lobby video boards. to name a few items, for the office tenants as well as the retail tenants. They've painted the exterior of the building, and then instituted a spec suite program in the office component, which we're going to continue to do, which is basically a plug-and-play office build-out for a new office tenant to come lease as minimum as 800 square feet up to 3,000 square feet, to where they can make an easy decision and move in within a very quick time frame. And on that particular program, they spent a little over $1 million, and we're going to continue that program in retrofitting. There's only currently 3 vacancies in the project in the office side, and we'll start instituting that spec program as we speak. The retail is effectively full. There's no vacancies, so I can't do anything there, which is good. One last point on just a key deal point is the overall parking ratio. It's extremely important for our tenants and our visitors to have availability parking. With the high parking ratio of this particular tract, it has just under 4 per thousand parking, which is great for the overall office users, which is allocated about 3 per thousand, as well as the difference being about 7 per thousand for retail component, which is great for the type of uses that we have in the retail component in terms of lunchtime and morning traffic for breakfast and lunch, which is majority of when the parking is coming in and out of the building for the retail users. So those are some of the key deal points. Going forward, some of the things we're going to continue to do in the business plan, and if Justin, if you want to move down to the business plan, as I mentioned, this is a very large tract, roughly over 5 acres, which is a very large site with surface parking, which the eastern edge abuts the Federal Center light rail station, And as I mentioned, we're going to upgrade the existing vacancies and retrofit those to a spec suite program for a plug-and-play type lease. We're going to continue upgrading the common area corridors that are currently some of the ceiling heights. We're going to expose the ceiling heights to create a more creative or technology type tenant base. The current tenant base is roughly 15% technology in the office component, and we think catering to these technology type tenants, creative type tenants, will help push our rents and our overall tenant base diversification in the project. We also are looking for ways to maybe increase the value of the project by, not included in this offering, by acquiring adjacent land to round out the total site to roughly 8 acres to add potentially more parking, surface parking, a deck parking, and maybe even more retail in the near future. Further, we're going to hire a third-party retail leasing agent to assist us in maintaining the curb appeal of the asset, as well as working alongside of us with our tenants to maintain strong relationships and make sure that the retail tenants are happy with their existing space, hopefully, obviously, to renew those tenants in the future. Lastly, I mentioned just the overall location attributes with the adjacent hospital, the light rail station to the east. One thing that, as of note, that on the location that bisects the property is a pedestrian access that comes from Union Boulevard and directly crosses this project through our surface parking area. There's a dedicated 10-foot sidewalk that you'll see on your screen that goes directly to the RTD park and ride area. And what they've called this, it's the first of one of the pedestrian crosses. It's a dedicated pedestrian crossing that's lighted called an Eagle Crossing. Due to the amount of foot traffic and number of employees and population on the west side of Denver and the office buildings, a lot of the tenants in those buildings like to cross Union Boulevard and access the retail amenities at our project. And due to that, they added this Eagle Crossing in addition to commuters parking in the parking lot at the RTD will come across our project into either our existing asset or other competing and/or retail establishments on the west side of Union. So this will continue, we believe, as the market improves, as the location attributes, as kind of the ground zero for the overall transportation-oriented development right there at the train station. This location, long term, we feel is will retain its value, and we through our 4-year hold period, we hope to market tenants and increasing their rents as well as maintaining the existing occupancy. That's been almost 15 minutes, so I will. That's a general summary of the investment, and if there's any additional items, Justin, you would like me to add, I'm happy to do so, but otherwise, I will turn it back over to you, Justin.
Thanks, Andrew. Why don't we walk through a few of the tabs in the investment section of the offering, specifically the distribution waterfall, sources and uses, financials, and sponsor fees.
Sure, happy to do that. Why don't we just start with high level, which would be sources and uses. So we currently have a 14.5 plus or minus senior debt facility in place. We initially capitalized that the closing back in January with Texas Capital Bank, who is our lender. They're a relationship bank with us, and they have provided us loans in the past, and they provided us very flexible rate debt terms to invest in this project. Of that $15 million, approximately $1 million of those dollars will be used to improve the project in terms of capital improvements, tenant improvements, as well as commissions for brokers to maintain the occupancy. And the difference being the invested equity in the project, investor equity and sponsor equity. And then in terms of the uses, obviously the total purchase price, additional capital, as I mentioned, that Texas Capital Bank has committed to invest in the project alongside us. Obviously closing costs and loan and legal fees total to the total uses of $22.25 million.
There are no sponsor fees. There's no acquisition fee or disposition fee. That's our standard, Griffin Partners standard approach to offering co-investment opportunities. And there is, the waterfall is, there is no waterfall either. It's pari passu. So CrowdStreet investors and all of the co-investment partners in this project will receive distributions on a pro rata basis based on their percentage interest with identical terms as the Griffin Fund 3 investor. And maybe with that, it would be a good time to go to the projected returns. Justin? Andrew, I'll let you cover that.
Yes, so this is just the projected cash flow and net cash flow to investors after debt. As you can see, roughly an $8 million investment with a little over 8% cash on cash in the first 2 years, and then that wind slows down a bit. One, for two reasons. One, the rollover of the office tenants in years 2, 3, and 4. About 60% of the office tenants roll in that period of time, and that's what we would hope to market those tenants. And in order to do that, you're having to spend allowances to keep them from their, paint and carpet, et cetera, to keep them in the space. And then also we've underwritten and bought an insurance policy on our interest rate on our debt. So we have imputed interest rate rises during our hold period, as well as purchased a 3.5% interest rate cap to forego any interest rate volatility that goes above that amount. And so on an average basis, over the life of our investment, you're roughly achieving a little over 5.6% average cash on cash. And our investor returns, total imputed IRR, over the hold period is roughly 15.5%, with an equity multiple of 1.7%. times your money. And we've got a few hypotheticals, $100,000 and $50,000, and it'll show just dollar for dollar. If you just did the percentage interest, your pari passu dollars at $100,000, you get the same yield on your investment as our equity.
Thanks, Andrew and Edward, for that presentation. Now we will open it up to investor Q&A for those that are on the line. As a reminder, just type your question directly into the question window on your GoToWebinar control panel, and I will ask the question on your behalf. And if for some reason we don't get to your question today, the sponsor will be providing responses to those questions after the webinar, and those responses will be posted to the detail page for everyone to view. First question we have is that most CrowdStreet offerings are structured as LLCs. However, this one is a partnership. Could you talk about why you decided to structure it this way, and what are the advantages and disadvantages of each structure?
Sure. This is Edward Griffin responding to the question. Griffin Partners actually historically has used partnerships as opposed to LLCs, and quite candidly, that's a legacy of being from Texas, because until recently, the limited partnership vehicle was tax advantaged over the limited liability corporation vehicle here in Texas. And while obviously this property is not in Texas, it's kind of our default structure, and is the one that our other co-investment partners who have invested with us over the years have become accustomed to. So typically, when we are expecting to offer co-investment opportunities to our existing, pre-CrowdStreet stable of investors, because it is the form that they're most used to seeing, we default to it. We occasionally use LLC structures, and frequently actually use them when we are making investments in larger transactions wherein we have an institutional partner that we're investing alongside. And there really is no difference, the last part of your question, there really is no difference from a tax perspective either to the limited partners or the limited liability members of an LLC versus the limited partners of a partnership at this juncture in any state that I'm aware of where we own properties. That would include Colorado in this case.
Edward, what about from a tax reporting perspective? What tax forms will prospective investors receive if they did choose to invest on an annual basis?
So investors will receive a K-1 for the federal taxes, as well as a similar form for state of Colorado taxes. We will be distributing those by the 15th of March in the year following the tax year in question. And we are expecting that the K-1s are, they're produced by, our accounting firm, which in this case will be BKD, which is a large regional kind of Midwest, middle of the country accounting firm with whom we've had a 8 or 9 year relationship at this point, and very successful in getting them to perform for us and answer questions and deliver timely materials.
Thank you for that. What does it mean to mark-to-market the tenants?
I'll let Andrew answer that.
Yeah, this is Andrew. So if a tenant is currently paying $22 gross per square foot per year for their office space, and they signed that lease 3 years ago, and they signed a flat lease where it had no bumps, where it just paid $22 gross per year for the term of their lease. And sure enough, when they come up for renewal, the market has improved, and market rates are 26 gross per square foot per year. That would be a mark-to-market opportunity.
And actually executing mark-to-market would mean that you got them to sign the renewal at $26.
Correct. So when we mention mark-to-market opportunity, especially in the office component, there is since they're smaller tenants, they tend to sign shorter-term leases, 3 to 5 years at most, and so there's constant. Every year, you've got 4 or 5 tenants rolling or expiring, and we hope to renew them at a higher rate, i.e., marking them to market.
Great. How frequently will you expect to make distribution payments to investors, and when do you expect to begin those payments?
We will begin those payments no later than June 20th of this year, so approximately 60 days from now. It is possible that they might start sooner. We will be making distributions on a monthly basis.
What do you consider to be the largest risk factors in this offering, and what are you doing to mitigate those risks?
One of the largest risk factors on the current tenancy is that and the downside chance that one of the major retail tenants were to vacate. That is currently not the case, but that could be a major risk factor going forward. The largest tenant, which is called 240 Union Grill on the north end of the retail center on the opposite side of Jason's Deli. They are a white tablecloth, locally owned retailer. They've been in this location for almost 20 years. I've mentioned them solely because they're the largest retail tenant, but their expiration is in a number of years outside of the term of our hold period, but they are paying a below market rate, which we feel comfortable with because that reduces the risk of them wanting to reduce the rent even more. But I would say that on the retail side, it would be maybe losing one of the major tenants. On the flip side, the office, there's no one tenant that is, as I mentioned, greater than 10% of the overall office component. Regis is the largest tenant, and they're currently occupying all of their space, and they are in current occupancy and will not expire until 2026. So don't see any real major tenant risk today or really in the foreseeable future. Trying to think of any other major downside. Obviously, we're in a market that fluctuates. Denver as a whole fluctuates as an economy. Overall employment growth in Denver has slowed in the last few years, but still above the national average. We see, positives from a macro standpoint in West Denver. Considering those attributes, there's very few downside risks, but there are, of course, all types of risks that can happen in any investment.
In addition, there's a little bit of interest rate risk. We have underwritten gradually rising interest rates. If for some reason the loan is a floating rate variable loan, if for some reason the anticipated gradual rise in interest rates were to be dramatically accelerated, that could cut into the first year or two cash flow. As Andrew previously mentioned, we did acquire an interest rate cap from a credit-worthy third party that caps our exposure about a little less than 2% above where short-term rates are right now. So
For the term of the loan.
Correct. So it's possible that cash flow could be impacted if the rise in interest rates is dramatically more rapid than the market currently anticipates. And we've mitigated that with the cap.
Can you discuss the 59-acre development that looks to be adjacent to the property as part of a land sale? What's the plan there? What's the timing, and how do you believe that will impact the property positive or negatively?
Yeah, it's a very large tract just northeast of this project. Over a year ago, it was out to the market via a request for proposals for the GSA to partner or sell the tract to parties or developers. From our understanding, that process is slowed because there's environmental issues from years and years ago, back from World War II, that have not been completely finalized and approved. But most recently, I think that has been solved and completed. They did bring it back out to market late this past year, and from our understanding, was also denied. There was a shelter. The Housing Authority, Colorado or Denver Housing Authority, wanted to build a shelter for the needy, and that was denied for City of Lakewood Council, from our understanding, and the project did not go forward. Now it's been reissued, I believe, through an RFP process again for potential multi-use development, and that is where it currently stands. The site is located just kitty corner, but it's also located at a grade level that's much lower. It's hard to see on a map, but it's about 15 feet lower in terms of elevation, plus or minus, than our particular site. So we've got unobstructed views really starting on the second floor over the parking lot of the tract to the south, the 12.5-acre site. So the views are very good. It will not, if that was developed, it would not impact any views. I think if it is developed, not as a housing authority or a shelter, as multifamily, medical office, additional garage, retail, maybe even office or medical office, I think it actually is it's an overall positive for this particular asset, because we think all boats would rise with that new development.
Can you talk through the sort of upside and downside scenarios that you modeled as part of this transaction that might not be represented by the targeted return shown on the detail page?
Sure, happy to do that. So we typically always run various risk analyses. I guess I'll start off with the downsides first, and then I can talk a little bit about the upside. So downside, we really look at capital markets risk in terms of our future residual value and how cap rates might be viewed in the future, and we stress test our residual value by increasing our cap rate, i.e. not getting as strong a cap rate or getting a lower price per square foot on the exit, and moving those up and down the spectrum from our current cap rate is roughly a 7% cap rate, a roughly $25 million sale price. If you were to increase that cap rate by 25 basis points, every 25 basis points impacts IRR roughly 150 to 175 basis points downward on a levered basis. So you get a 7.25 cap rate, you're roughly a 13.75 to 14% IRR. We also look at rental rate growth and how we've underwritten conservatively virtually no rent growth for the first average inflationary rent growth between the office and the retail of just under 3% as a total. We've underwritten some rent growth in the office of 4 to 5% in the first 2 years and then back to inflationary growth. And on the retail, we've only assumed about a 2% increase in rent rates, so blended plus or minus 3%. If we were to...
Per annum.
Per annum. So we look at, obviously, rental rates. We also look at overall historical vacancy in the project. We're carrying a 7.5% vacancy factor. We've stress tested the model to where we have a 12% vacancy factor, which is greater than the overall average occupancy over the last 3 years. How would that impact our returns? And then lastly, we look at major tenant concentration, of which we don't necessarily have any major tenant concentration, except for in the retail, we have one large tenant, which I mentioned earlier, the 2440 Union Grill, with the outside expiration date of 2026. We don't see a lot of, downside issue with that tenant. The downside scenario is they would leave early, but considering they're only paying 28 net and the market today is roughly 34 to 35 net, we think there's an opportunity to move rents up even higher by attracting a new tenant to that space. In terms of kind of upside, overall market continues to tighten, vacancies continue to decline, rent rates, we continue to improve our project and equal our competitive set in terms of rates. The competitive set actually averages higher rental rates than this project, so if we could get closer in terms of the office component, get higher office rents, we think we could push our returns. If the 60-acre tract is actually developed into a mixed-use project, attracting more visitors and more pedestrian traffic, we think we could push retail rents and obviously sell, we think, the project for a better basis, increasing our levered returns to the high teens. So those are some of the upside scenarios.
Can you talk through Griffin Partners' success in completing similar investment offerings? And specifically, I've got pulled up here in your track record section summary valuations as of December 31st, 2017. Can you just walk through kind of what we're looking at and speak to what your returns have been historically?
Sure. Edward Griffin speaking again. As I mentioned earlier, we're presently deploying capital for our third fund, which means that we obviously had a second fund and a first fund. And then in addition to the first fund, what you see at the top of the screen right now are a number of standalone investments that we did outside of any fund structure. All of these properties are similar in basic characteristics as the current offering at Union Plaza, at least with respect to office buildings. And primarily our track record has been office buildings. We have done some industrial, and we continue actually to try to increase the proportion of industrial deals we do. But our track record that you see on the screen is the vast majority of those are office buildings. One thing of note is that we don't have any negative returns on any of these investments. And they're not cherry-picked. That's all of our value-add and core plus investments since 1998. And the key characteristic and feature, frankly, that's I'd like to take full credit for having no negative numbers on there, but in reality, the real reason is that we never borrow too much money. And as you saw when we covered the sources and uses earlier in this presentation, the loan to cost on this deal is about 64%, 65%. Our fund actually has a covenant that caps leverage at 65% of cost. Cost is of course not an arbitrary number where value sometimes can be arbitrary, so we feel it's best to peg it to cost. And when you do that, you you maintain maximum flexibility and the ability to maneuver even when either the business plan doesn't go as anticipated in some adverse fashion, or the economy turns down and you have to get a little bit more creative and aggressive to maintain the value of your property. It's always good to have the flexibility of not having too much debt. All of these properties that you see in the track record are in the markets that we target, which are Denver, Phoenix, the 4 major Texas metros, and the 2 major metros in North Carolina. And that the other component of that track record that I'll point out, if you scroll down a little bit more towards the bottom, Justin, is that what you see on the right-hand side, the far right is the IRRs for each of the investments, the moving to the left, the equity multiple column, and then the annualized cash yield. Another feature of our approach is that we focus on properties where we are able to generate and produce a cash flow during the hold period, and not just have all of the return come from a gain on sale. And that is an additional attribute of kind of in what we call investing in the middle bucket of the risk spectrum. So a portion of your return comes from cash flow along the way, and a portion of your return comes from gain on sale. And the way to assure that is to invest in properties that have existing in-place contractual rents, but that are underperforming for some reason that you think can be fixed, either underperforming significantly or, in the case of this property, for example, underperforming slightly. Rents are a little bit below market. There's some additional, in the case of Union Plaza, there are some additional things that can be done to improve the appeal of the project. Andrew mentioned earlier, one of the upside cases is that we're able to push the office rents up closer to where some of the competitive buildings in the market are. He also mentioned separately from that that one of the things that has been done so far and we continue to plan to do is to raise the ceiling heights and make the space more what we call creative office or tech-oriented space by opening up the ceilings. So, for example, if we continue to do that and we get a $2 or $3 bump in rents as a result of making that space more appealing to the way tenants are currently demanding their space to feel and look visually, then that gives us the opportunity to improve the rents and to push our returns. If you scroll down just a little bit further, Justin, or at least on my screen, the bottom blue line with the white numbers is the cumulative track record through, on a weighted average basis, through the end of last year, December 31st, 2017. Total of almost 6 million square feet of space, where you can see that our average cash on cash is about 7.2%. I'm on the third column from the right. The equity multiple is a little over 2, and the IRRs right exactly where we're projecting for this project, coincidentally, 15.5%.
Thank you for explaining that, Edward. Last question that we have is, can you discuss, with respect to the K1s you mentioned, will investors have to file individual taxes in the state of Colorado if they don't live there?
I'm glad you asked that. I meant to mention that earlier. Thank you, Justin. No, our approach to investments outside of the state of Texas, because our history obviously being here, but actually the biggest reason is Texas doesn't have personal income tax. Colorado does. We pay the tax for investors, and the K1 they receive shows if there's a tax due. Frequently there's no tax due. In fact, there's usually a loss, particularly in the early years. Of course, that's subject, this is not tax advice, but that is subject to any passive loss limits the investor might have. but we pay at the property level the state income tax, if there is any, and the K-1 that is received will show a credit for that tax having been paid. Thank you for asking that question. That's an important question.
Absolutely. And I apologize. We just had one last question come in here. With respect to the year 4 cash flow of 1.6%, can you talk about the risk of having such a low cash flow in this year, and what would happen if you were unable to cover those expenses? What would the backup plan be?
Well, first and foremost, that cash flow includes inflationary growth of all operating expenses for the project, so that is net of any expenses.
Also has inflationary growth with capital expenses too.
Correct. And so we've got capital growth as well as operational expense growth, and that $160,000 or $300, depending on the amount, $125,000 is net of those expenses, and it's also net of any future tenant improvements, leasing commissions, as well as debt service. So it just so happens in that particular, in year 3, which is the fiscal year 2020, in year 3, the rollover that happens in year 4 because of the downtime, you have about 30% of the project rolling in that year, which falls into fiscal year 4. Therefore, you have a fair amount of TIs and commissions, which reduces the projected net cash flow for year 4.
TI stands for tenant improvements. The backup plan, assuming that, well, a couple of things. The backup plan would be if we felt like that we had under budgeted for some costs that were going to be incurred in year 3 and or year 4 for whatever reason. For example, let's say that the cost of tenant improvements in Colorado goes up by 50% because there's a natural disaster that creates a labor shortage for all the construction contractors. I'm just making that up. But so if we had visibility to some cost increases for those capital expenditures in the 3rd and 4th year, the primary backup plan would be to begin reserving additional capital and actually lowering distributions in year 2, for example, or year 3, to preserve additional cash and be able to spend that in year 4. If the we have rarely, if ever, that I'm aware of, so that plan is with respect to anticipated capital. With respect to anticipated operating expenses, of course, we budget every year, and then we reforecast mid-year. And if there are operating expenses that are, for some reason, beyond our pro forma projection for that year, then we're going to dive in and figure out why. And we've really rarely ever had situations where we were substantially off with respect to operating expenses. In fact, if you were to look at, our monthly reports, which investors will receive, will show a comparison of the financial performance to the underwritten performance. And typically, unfortunately, 4 years out, you may be off on rent. Hopefully, you're off to the low side and rents are higher. But typically, when you look at our monthly reports, you could be 5, 6, 7 years out on a longer-term hold, and we're within less than 5% of being off on our operating expense guess. So we're exceptionally good at managing operating expenses and don't really view that as a necessary thing to have a contingency for. And then in the event that the occupancy actually underperforms, many of those capital expenditures would not be required. So while we certainly will manage to maintain maximum capacity from an occupancy standpoint of the building. If the market scenario is such that all the buildings in market are underperforming or experiencing higher vacancies, and we are as well, some of those capital expenditures are not going to be required. Obviously, revenues will be a little lower as well, but some of those 3rd and 4th year capital expenditures would not be incurred, and therefore, it's unlikely that there would need to be a contingency for that. And then lastly, as long as we stay below our 65% of cost, kind of the third contingency that is available to us is to refinance the loan with additional proceeds. So as I mentioned in the first scenario, for some reason we underestimated capital costs, but otherwise the building is performing and the NOI is consistent with our projections, then we should be able to go out and refinance our loan in a fashion that provides us an additional bucket of loan-sourced capital, again, staying underneath that 65% of cost limitation.
Thank you, Edward and Andrew, for that presentation. And thank you, everyone on the line, for attending today's webinar. More information about the Union Plaza at Federal Center Station is available on the marketplace for all in-process offers. As mentioned at the beginning of the webinar, the offering is currently fully subscribed. If you have submitted an offer on the marketplace and had that offer pre-approved, you are included as the group of investors that will be allowed to complete their investment on a first-to-fund basis. You can expect more information from CrowdStreet regarding that basis. If you do have any questions, please email ir@crowdstreet.com, and that will be the end of today's webinar. Thanks, everyone.